There's a lot of different calculations for duration. The duration calculation that we use is effective duration, which accounts for some of the embedded options of the forward TBA contract that we trade. The functionality that we have is we're bringing that spec duration component forward for the lenders to have access to, and lenders to be able to see the spec duration that we're using for their hedge, and to kind of tailor that to be specific to their own spec stories and their own spec duration. You could have somebody over in one region of the country that could have a pay up of 10, somebody else in another region of the country that has a pay up of 8, and they could be similar spec stories. Price sensitivity factor affects the value and the underlying value of the loan. So that's what this is doing, is we're bringing that forward for the transparency for the lender to be able to see what that is and be able to modify that on their own. One thing that we've always kind of preached is hedging to your execution. So if you're not hedging to your execution, then you're kind of missing the boat, and that's what you need to make sure that you're hedging to, right? Because at the end of the day, you want to make sure that you're locking that loan at the margin that you have set, plus the added benefit of taking on that mandatory risk. It's important for mortgage lenders right now because everybody's scratching for every basis point, and this is a great way for people to get that value, not only down to the borrower, but also to put that in their pipeline, and also put towards their P&L. Reason all goes back to how the bond performs and to the prepayment assumptions that are baked into those spec stories. So that essentially helps drive the characteristics of the prepayments, which also get calculated in the duration component when we're looking at how that affects the overall duration value. So the spec story, let's just 85K, or the price sensitivity on that is higher. So therefore, you're going to have a higher duration on that, just given the sensitivity of the spec story. So that's why we're using that to account, or that's why we're using that in our calculations for coverage when we're trying to make sure that we're managing the interest rate exposure position correctly for the lenders. So having the spec duration in the hedge is critical, especially for those lenders that have the regionality of the spec stories in their open pipeline. I think it makes sense to have in the coverage calculation for all lenders, but I think depending on the size and depending on the makeup really determines what kind of effect it's going to have. And at the end of the day, it might only have a marginal effect, but it could also have a larger effect depending on how much of your open pipeline is valued in that, or how much your open pipeline has that spec story. I really do think it's, just a component of where we're headed in the future. Because right now you're seeing these spec stories that have kind of been, pretty commonplace for a while. And I think a lot of people have understood what's going on. But now we're getting to a point to where there's more spec stories starting to hit the market, and there's different spec stories starting to hit the market. So it's one of those things where we're just trying to make sure that we're getting ahead of it enough to offer the lender the capacity to manage their interest rate exposure position appropriately. Because there's going to be a time where, there's going to be a spec story out in the market that nobody really knows about, but a lender has a specific production in that spec story. But if they're not able to hedge to it appropriately, then, they could be losing some value there. So that's where we want to make sure that, we want to look into the future. We want to make sure we're able to handle, these different spec stories and different iterations that could come up and that will come up as move into the future. I think it's prudent for us as a hedge advisor to kind of be ahead of what we see coming and make sure that we're offering that flexibility and opportunity to the lenders.